The market seems calm today, but the real volatility is building beneath the surface. The rate cut today is just the starting point, but how the valuation spreads over the next year, whether technology can survive, and whether the cycles will transition, that's the real power. And it all starts today. Hey everyone, I'm Frank. It's early on December 10th, at 25 basis point rate cut is almost priced in, and the index is just one step away from its historical highs, but no one dares to take that step with heavy positions. The reason is simple. It's not the number that determines the 2026 valuation framework, but what Powell says later in the press conference and how he says it. Over the past few days, the S&P 500, Nasdaq, and Dow have almost been moving sideways with very narrow intraday ranges, and volume has significantly decreased. The 10-year Treasury yield has remained above 4.1%, approaching 4.2%, which shows that the bond market doesn't fully believe that the next year will enter a flooded easing cycle. The stock market is waiting, the bond market is cautious, and neither side is willing to give in first. The real direction will be revealed after the rate decision at 2 p.m. and Powell's remarks at 2:30 p.m. So the key today is not, will the Fed cut rates by 25 basis points, but rather, the market has already priced this in. What really moves the market will be Powell's tone at 2:30 p.m. Will he emphasize inflation risks are still here, or admit the economy is slowing, and we need more easing? I won't guess his exact words. I will only watch how price and volume translate this message. Price is the real language. Historically, the most common rhythm on FOMC days is a sharp reaction when the interest rate is announced, followed by an even larger reverse move before and after the press conference. The first wave is often a fake move, while the real trend typically appears after the halfway point of the speech, when the market starts to reorder itself. In past meetings, the direction was mostly confirmed 30 to 90 minutes after the speech. Those who rushed in early often ended up as the counterparty. So, my rule today is simple. Don't chase the first wave. Wait for the second one. I'm not excited by a big spike. Nor am I scared by a big drop. I'm waiting for the second pullback or second breakout. As long as I can avoid jumping in during the fakeout, even if I miss a small part of the range, my overall win rate and mindset will be much more comfortable. Trading isn't about speed. It's about certainty. The 10-year Treasury yield has been climbing from its lows over the past few weeks, mainly because funds are starting to doubt the scope for easing in 2026. If the dot plot and forward guidance show only a few token rate cuts before moving into a wait-and-see period, long-term rates may continue to rise, which would be bad for high-valuation growth stocks. If it suggests a faster and longer duration of cuts, the curve will flatten, giving tech, consumer, and high-beta assets room to re-abate valuations. The bond market's attitude is cold. It doesn't believe in stories, it believes in cash flow. If the bond market continues to hold that, rates won't drop back quickly. Every rally in tech stocks will be seen as an opportunity to rebalance and reduce positions. If the bond market accepts that the next 2 years are a real easing cycle, then after today, many will realize they are on the wrong side of the trade. On the index level, the S&P 500 is currently stuck around 6,900 points, with 6,920 being the key resistance for a short term. If it breaks and holds above, the market will naturally challenge the 7,168, 7,210 extension zone. If the tone is hawkish and short-term selling ensues, breaking below the 50-day moving average would put 6,500, 6,550 in the next support zone. This zone isn't just made up, but is based on volume accumulation over the past few months, marking the footprint of big money. I don't expect a straight-line breakout. That kind of move often lacks momentum. What I'm hoping to see is, first a washout, clearing out the most impatient bulls and bears, then slowly building the real trend when everyone else is too scared to chase. As long as key support holds, this consolidation isn't the top, it's a build-up. The Nasdaq still has an unfilled gap above, and the bulls are clearly controlling the pace, not wanting to rush to the previous highs and trigger a large-scale profit-taking. Big money knows that if the gap fills too quickly, short-term profit takers will flood in, and bears will take the opportunity to pile in. So, they'd rather let the index hesitate a bit, causing retail traders to get frustrated and leave, rather than firing all their bullets before the real trend emerges. This is why I'd rather watch a few more candlesticks than frequently trade during this half-fill-in, half-uncertainty stage. After 2 days of emotional turmoil, people will think, I have to do something. And that feeling of having to do something is often where losing money starts. The hardest part isn't reading the chart. The hardest part is doing nothing according to the plan. Speaking of individual stocks, Nvidia remains the key anchor in the entire AI chain. Recently, there has been repeated news about the H200 export to China. On one side, the US government hopes to maintain a technological edge through controls, while on the other side, businesses and overseas customers want to get more computational power resources. If the policy becomes clearer, even with profit sharing and approval processes, it will still be a real incremental revenue for Nvidia. If it remains unresolved long term, the stock will just keep hovering at high levels. I'm not going to let Nvidia's short-term jumps or drops dictate my view. Right now, it's like a spring being held down. The fundamentals are fine. The orders are fine. It's just the valuation is too high and needs time to digest. It's been consolidating for 4 months, which isn't a death knell, but a turnover. The real danger isn't volatility, but high-volume consecutive large red candles. As for the financial sector, a few days ago, JP Morgan took a big hit after they lowered their 2026 cost guidance, serving as a reminder to the market. Banks are far more sensitive to interest rate spreads than the average investor. If the rate cuts come too quickly, net interest margins will be squeezed, putting pressure on bank profits. If the rate cuts are more gradual, and the economy keeps growing, it will help expand lending and reduce bad loans. The financial sector isn't a drag, but a thermometer for the economy and policy. This is also why I've always insisted on having assets that represent the real world in my portfolio, such as financials, energy, and industrials, rather than just stories about AI, cloud computing, and SaaS from the ideal world. Stories can sound beautiful, but what truly handles the cycle is cash flow. If you only hold dreams without cash flow, one of those pullbacks will knock you back to reality. The performance of energy and cyclical sectors recently is also worth noting. With expectations of peak interest rates strengthening, funds have started quietly returning to commodities, energy, and traditional industrial assets. If tonight's guidance is more dovish, the dollar index may weaken gradually, and commodity prices are likely to find support. If the guidance is hawkish, energy stocks may face short-term setbacks, but the supply-demand gap in the medium and long-term remains, and a pullback will be an opportunity to reprice. Whether it's AI, clean energy, or traditional consumer goods, it all ultimately has to go through 2 gates: interest rates and the economy. Interest rates give valuation. The economy provides income. This meeting today is actually telling us, in the next 2 years, how wide will those gates open? The wider the gate, the more people will rush in. The tighter it is, the more cash is worth than stories. Looking at sentiment indicators, the trading volume of call options has clearly increased recently, with retail and some active funds having high expectations for the market to continue rising into the end of the year. Demand for put protection has decreased, and overall sentiment is more optimistic. However, it's worth noting that optimism often appears in the middle or later stages of a rally, not at the beginning. If Powell's remarks are a bit too hawkish today, the short-term market may be enough to trigger a buy the rumor, sell the news profit-taking. So, I won't treat today as the day I have to do something, but as a turning point for repositioning my portfolio. If his tone is dovish, that means there's still room for easing in 2026, and I'll put more chips into high growth. If it's hawkish, that means we'll have to make money in the volatility of the next 2 years, so I'll increase defenses and arbitrage, reducing my exposure to one-sided bets. Apart from interest rates, AI regulation is also a new variable in the market. If a unified federal framework is introduced to replace the state-by-state rules, Big companies will benefit, as they have the resources to handle compliance costs, while smaller companies will struggle. In the long run, unified regulation will turn AI from a Wild West into infrastructure, and valuations will shift from pure stories to looking at cash flow and penetration rates. For investors, the message is simple. AI is no longer about who tells the best story, but about who can survive under real constraints. I'd rather put my money into big companies with computational power, customers, ecosystems, and cash flow than into those who are good at talking but have nothing real behind their words. Regulation will push out the bubble and push the real companies to the front. Looking at market breadth, the equal-weighted S&P 500 index has already made new highs, which shows that not only a few large caps are driving the market up, but the second and third tier companies are also starting to rise. Over the past 2 weeks, more sectors have begun to follow the rally, and the market breadth is expanding. This structure is usually not a top feature, but rather looks like the layout phase before an acceleration in the middle stage. The real top often occurs when only a few stocks are making new highs, and other sectors quietly fall behind. So I'm not going to automatically be bearish because the index is close to highs, nor will I deny there's more space just because it's already gone up too much. Trends are never linear. They go up and consolidate, up and rotate. What I'm going to do is not guess the highest point, but after every structural confirmation, take the wave I'm supposed to take. Where the top is, let the market decide. By integrating signals from interest rates, the bond market, breadth, and sector rotations, I can draw a conclusion. The current U.S. stock market is not a precarious high platform, but more like a fork in the road where the next slope will be decided. If the rate cut path is dovish, regulation is clear, and the economy doesn't land hard, then we might have a slow bull plus high volatility combination for the next year. If the path tightens and economic data deteriorates, then the high-level consolidation of the past few months will turn into a top formation. For me, both scenarios aren't scary. My script is very simple. First, interest rates and the bond market decide my overall risk. Second, the index structure determines whether I'm attacking or defending. Third, sector rotations decide who I buy specifically. As long as these three don't get mixed up, I won't be dragged around by short-term noise. From aftermarket to tomorrow morning, the market will likely experience a period of emotional swings. Some will lock in profits, some will stop loss, some will add more, and some will completely exit. Implied volatility in options has already risen, indicating that everyone knows there will be a big move, but no one dares to bet. In times like this, managing your position is more important than predicting the direction. Are you getting in with a seatbelt, or are you standing on the roof? Finally, I want to sum up everything in one sentence. Today isn't the end of the line. It's the fork in the road. You can try to predict which road will have the better view, or you can wait for the road signs to go up and then move. I choose the latter. When the trend is clear, I won't hesitate. When it's not clear, I won't move. The market doesn't care about your smarts. It cares about your stability.